just want to thank Peter and the organizers for inviting me to present my work. I'm going to, like Greg mentioned, I want to just talk about some issues related to analyst coverage around cross-listings, and with an eye towards what kind of questions we can answer when we look at the analysts around cross-listings. Before I dive into the research question, let me just give you an idea of the data that I'm working with. The academic literature and the popular press, they focus on listings in the US and UK, and rightly so. The bulk of the listings are in those two countries. However, many firms, as we've seen in some other papers presented today, cross-list on other exchanges. And what I hope to find by looking at a sample with other cross-listings, or what I hope to do, is to answer some important questions in the literature. So I utilize a sample which includes cross-listings from many different exchanges up through the year 2004. Now this sample was originally collected by a couple of finance professors, Sergei Sarkisian and Michael Schill, and they have two papers based on it, and I'll talk a little bit about what they find. But it includes over 3,500 cross-listings. And so let me give you just a picture. Here are the cross-listings by host country, and I haven't shown the maximum number of observations for the US. It's well above 600, but you see that in the UK or GBR, Great Britain, approaching 500. But besides those two markets, you'll see that there are many exchanges in Europe which attract a sizable number of listings. Belgium, CHE is Switzerland, Germany, France, Luxembourg, and then even beyond Europe, there are some Pacific Rim exchanges like Australia, the first one listed there, Japan and New Zealand, which attract listings. Now one thing that of course I haven't shown you, and I think what masks some of the richness of this data set, is I'm not showing you where these firms are coming from, only that they list on a variety of different host exchanges. So what I've done here is I've shown the home countries where we see most of these listings happen. And I think there are some interesting patterns, but first of all, as you can see, there are many Canadian firms, firms from Germany, France. The United States also has several firms that list abroad. But what I think is interesting here is if you look within the home host country pairs, you'll notice that there are some interesting clusters. So for instance, this one we know about Canada. Most of the cross listings are in the US. If you look at Australian firms, a lot of them list in New Zealand. That's where the bulk of those listings come from. You can see those, and you see some geographic clusters among these different home and host countries. Another interesting thing is if you look at Luxembourg, Luxembourg actually tends to attract Asian firms. So several from India, Japan, Korea, and Taiwan. And so there's some interesting patterns that you can see in this data, which I think reflect there are many different reasons why firms cross-list. And so the other thing I wanted to talk about is the listing requirements in these different exchanges. So we know the US and the UK have some of the strictest in the world, particularly on those primary exchanges, the aim notwithstanding. But what about the listing requirements in these other host markets? The easiest way to think about this is if you're familiar with the listing requirements in London on the main exchange versus AIM, that's probably pretty representative of these other host markets. Many exchanges allow foreign firms to list on a secondary market or as an exempt foreign listing. To give you a couple examples, in Australia, the Australian Stock Exchange allows these exempt foreign listings, and the requirements are lower for these foreign firms. They still have to file with the regulator in Australia, but I'll talk a little bit about the filing requirements. And then take Japan, for instance, as another exchange. The Tokyo Stock Exchange has several different markets. They stratify their markets, and they have different listing requirements. And most of the foreign firms end up on those markets where the listing requirements aren't as stringent. Now, relative to actual financial reporting requirements, many exchanges operate under this mutual recognition policy. And what that means is the host country exchange simply requires the firm to deliver its financial statements from the home country in the native language of the host country. In Australia's case, they simply require the firm to deliver the annual report and anything that they disclose in the home country in the host country. And what that means then is, if you're thinking about FSA with these financial statement analysis with these firms, is when you see the numbers reported in most of these host countries, they are what's reported in the home country. Now this is less of an issue nowadays, given that a lot of firms are reporting under IFRS. And IFRS is typically accepted on all of these exchanges without any reconciliation. So what I hope to do then is, with this variation in host country institutions, I'm going to look at that variation and relate it to changes in analyst coverage to shed light on what's known as the bonding hypothesis that's been alluded to by some other presenters. More particularly, what I'm interested in doing is trying to find out whether market forces are legal institutions, or together, whether these allow firms to bond. And so I'm going to talk about two things. The first is why I think I'm going to motivate this question, and then I'll talk about why I use analyst coverage in this setting. So quickly, the bonding hypothesis states that firms from countries with weak legal institutions have a hard time raising external capital. And it's been suggested that firms can overcome this problem when they cross-list in a host exchange that has institutions that deter managers from expropriation. Of course, the US is the prime example of that. Coffey and Stoltz were some of the first to kind of recommend this or suggest this hypothesis, and they list several institutional requirements. So disclosure requirements, the legal system, regulation, and market forces. They actually suggest that market forces are a way for firms to bond. Now in my paper, I make a distinction between what I classify legal institutions and then market forces. And the reason I make that distinction is, if you look at most of the papers that try to test whether firms bond when they cross-list, they focus on legal institutions, but there's some research that questions whether or not legal institutions can do the job. And the reason for that is that US exchanges often waive some of the governance provisions that are required for domestic firms. Firms cross-listed in the US are exempt from filing proxy statements. They don't have to comply with insider trading restrictions or Reg FD. And then more broadly, there's this issue of mutual recognition. If they're not reconciling any financial statements, these legal institutions may not bite in the host country. And so what I try to look at is whether market forces can fill this void and work in conjunction with legal institutions to bond firms. Now, the other important piece that I need to discuss is just talk about how I actually view market forces. How do I operationalize them in my study? Now, the way I view them is these market forces are fundamental characteristics of a country's financial structure. And I look at two dimensions of the financial structure. First, what is the principal means of dispensing capital? Is it through the equity market or through debt? And then I look at ownership structure at the country level, the average ownership structure. And I argue that these forces can affect reporting incentives even when actual rules and regulations aren't there to enforce disclosure. And the reason for that is, if you look in countries with strong equity markets and or diffuse ownership, the only way investors can have information in those settings is through public disclosures. Typically it's disseminated through public disclosure. And there's some anecdotal evidence in the US that US cross-listed firms, even though they're not subject to something like Reg FD, they still comply with it. And I've listed a couple firms here, Nokia and TV Azteca, where they comply with Reg FD even though they're not required to. Now, what I do then is I measure these legal institutional variables and these market force variables using some of the common variables that are seen in the literature. I have some disclosure indices. I look at an anti-director rights index, judicial efficiency, whether or not the firm is located in a common law or code law country, a public regulation index. And for my market force variables, I look at the size of the equity market, and then whether or not it's more bank-based or market equity-based. And then I look at ownership concentration at the country level. And what I do is I look at the host country institution relative to the strength of the home country institution. And the results that I'll show you, I create indicator variables that I prefix by IND to denote those observations where the host country institution is stronger than the home country institution. Now, the next important thing is, why do I use analyst coverage? Why is analyst coverage a good variable to look at? Well, in bonding studies, what researchers try to do is they try to find a variable that shows that to try to capture whether or not a firm is better off after it's listed than before. And so I motivate my use of analyst coverage based on the fact that it's a measure of a firm's information environment. And there's some work by Langlands and Miller that look at analyst coverage in a US cross-listing setting that motivate it similarly. And the reason the information environment is important is it can lower the cost of monitoring the firm and limit the expropriation of cash flows. And so if we see the information environment improving after the listing, hopefully investors are better off. And my main variable in this case is what I list here as dCov. It's simply the change in coverage from 6 months before the listing to 6 months after. And I adjust it for one of the things I adjust it for is to get around this issue of coverage in IBIS increasing over time. I adjust it for the median increase in coverage at a given home country. And then I simply associate changes in coverage with my legal institutions and market force variables. And my hypotheses are fairly simple. If legal institutions are leading to this bonding effect, I would expect legal institutions to be associated with positive changes in analyst coverage. And the same goes for market forces. If market forces are leading to this effect, I expect to find a positive relation between changes in coverage and market forces. Now, there are several caveats to this study. First of all, if you think about why firms cross-list, there are many different reasons. In fact, bonding, we know, isn't the only reason that firms may cross-list. And if you look at my sample, some of the things we talked about in terms of clustering, it's obvious that firms from Australia may not be listing in New Zealand to bond. It may be more related to geography, culture, and that's what one of the Sarkisian and Schill studies looks at. They show that a lot of it is determined by proximity, just geographic proximity. Also, if you think about just arguments related to reducing barriers to investment and increasing the investor base, trying to improve the attention that you get in a given market, issuing equity, firms may issue equity, and along with that, oftentimes, in most cases, analyst coverage comes with that. And then some other people have referred to accessing the expertise of foreign analysts in a given market. And so these and other things can affect analyst coverage. One of the other problems I face is it's hard to separate market forces from legal institutions. They're endogenous. They're endogenous, and so I'm going to talk about one test where I try to get around this issue. Before I jump into showing you some of the multivariate analysis, let me just show you what coverage looks like, the change in analyst coverage looks like across several different host countries. And keep in mind, this is adjusted for the median change in coverage, and that's why you can see some, so for instance, the min is not a round number. I'm adjusting it for the median change in a given home country. But for instance, firms that list in France, you see a positive increase in coverage. Same for Great Britain, Japan, and so across several of the host markets that I capture, analyst coverage increases. Okay, and the increase in coverage has been documented in the UK and in the US. But as far as these other markets, this paper shows that it's actually fairly widespread across different host countries. Okay? So what I do is I take these changes in coverage and I build a model of analyst coverage based on several variables. And if you look in the literature, there's not a whole lot of literature that actually provides some theory about why analysts cover certain firms. It's typically based on arguments about what are the costs and benefits analysts come up against when they're trying to choose which firms to follow. But I model this change in coverage as a function of prior existing coverage, so the log of coverage before the listing, the log of the return over that same time frame where I measure the change in coverage, the change in size, market to book ratio as proxies for growth. And then also I include an indicator variable of whether or not the firm's issuing equity when it cross-lists. And then finally I include one of my institutional variables to try to get at how market forces and legal institutions affect this change in coverage. So the first table I want to show is Table 5, Panel B, and it's simply, the model got cut off a little bit up there. But what I'm doing here is I'm including each of those institutional variables that I showed you individually in the model. And the results for those institutional variables are here, but let me quickly talk about, if you look at, this is prior coverage. Firms that list, that have a lot of coverage already, tend to get a smaller increase in coverage when they list, which is not surprising. Firms that issue equity also, this shows that they get more analyst coverage when they list. But my hypotheses predict that the sign on the institutional variables for these legal variables is positive. And in most cases it is, but it's only significant in one, in the case of judicial efficiency, suggesting that the efficiency of the judicial system increases analyst coverage, improves the information environment around a cross-listing. Now the rest of this table looks at the market force variables. And I show that, so the prediction is the same here. I expect a positive sign on these coefficients. And I find that when the market is bigger in the host country than in the home country, firms that list in those host countries attract approximately one more analyst. Same for whether the system is more equity-based than bank-based. And when firms list in countries with more dispersed ownership, they attract more coverage. Remember, this is all relative to the home country, the strength of the institution in the home country. Now, as I mentioned, one of the problems I face is separating legal institutions from market forces. And some of the other papers in the table, I actually include these jointly and get fairly consistent results. But one of the things I wanted to try to do was to just simply say, okay, we know that they're related, but if you take two markets like the US and the UK, where it can be argued that the legal institutions that are actually applied to foreign firms are stronger in the US, but the market forces are they're more comparable across these different markets. Both are very large equity markets, very liquid. And so I'm trying to hold market forces constant and let legal forces vary in terms of the US is stronger than the UK. And if legal institutions are driving this change, then I expect firms that list in the US to attract more coverage. And so when I do that, and I include simply an indicator variable for US listed firms, the sign is actually negative, but it's not significant. So there's no evidence to suggest that firms that list in the US versus those that list in the UK attract any more analysts. And so this suggests that it can't just be legal institutions, that there may be other things like market forces going on. So, 5 minutes? All right. I'm done, actually. So, let me just say a couple things in conclusion. So, I think what my paper shows is that analyst coverage, this phenomenon of analyst coverage increasing in the US and the UK, is actually widespread in several different host markets, suggesting that the information environment itself shifts around cross-listing in other markets. And the increase in coverage is concentrated in host countries with strong market forces, but there's also evidence that legal institutions do play a role in bonding managers when they cross-list, in trying to deter expropriation. That's it. Thanks.
Questions? You know what I think would be really interesting too, if you could, something we used to always get when we wrote those first couple of papers was, where's the analyst from, right? Is it a local analyst, is it a foreign analyst? And we'd always just punt and say, we can't get that information. But I think, Renee Stoltz has a recent paper that actually has a nice way to identify whether they're local or foreign analysts. And it would be really interesting, I think, to see, this change in coverage, what drives whether it's a local analyst versus a foreign analyst, and weaving that in might make some of the stuff really interesting as well.
Yeah, and so this is actually a great point, and I went down the road of trying to get some of this data. There's a Stoltz paper, and there's also a Welker paper and a couple of the co-authors in Queen's University. The problem is when you look and you try to get that data for most of the firms I have, it's just not available. You end up only identifying analyst location in about 40 or 50% of the observations. So, yeah, it would be great to know that. In fact, one of the things that I've thought about is maybe not getting to that level just because the data's not there, but thinking about documenting how the analysts that are actually new at the cross-listing versus those that are existing, and maybe that could say something about this type of thing. Yeah. Great. All right.
I have two small questions.
Sure.
The first one, I wasn't clear whether you control for size. Did you control for size, firm size? And the reason I ask that is, if in the action of cross-listing the firm has merged with another firm and there was a process of the firm growing in size, there is evidence that analyst coverage increases with size.
Yeah, and if you look, these firms are huge firms that I end up actually having the data for in my sample. So I have both looked at the level, the size before cross-listing, and in the results I report here, it's actually the change in size, so it's growth. But I have looked at whether the level affects the actual change in coverage, and the results are robust to including something like that.
And the other question dawned on me today was whether over time there has been changes in the, let's say, the productivity of analysts. That is, they cover more, so that is, they spend less time. I mean, this is really an experimental question. Whether it's possible to find the number of firms that are being covered by a single analyst and control for that.
Yeah, I can definitely do that. The data is there in IBIS to be able to know how many firms each one of these analysts is covering. And it's the subject of some other analyst studies, so I could definitely try to control for that and look at, related to the point made before, if I know which ones are actually new when they start this change in coverage. Are these analysts that already are covering a lot of different firms? Do they maintain coverage for a year, for 2 years, and look at how they're changing after that?
I'm just trying to figure out what maintained assumption there is in here about the propensity of managers to expropriate, and therefore the need for managers to for good guys to bond. Are you assuming that the propensity is constant across countries?
So the propensity to expropriate, essentially.
Right.
So that's a good question. I mean, I don't think, explicitly I don't make any assumptions about that, but the implicit assumption may be that it's constant across countries. So I don't address that in the paper, but that's a good point. I mean, I should...
Because the causality could run the other way around. Institutions may be endogenous and depend upon the propensity to cheat, right?
Yeah.
And if relatively weak institutions are associated with cultures where the propensity to cheat is lower, your results would flow through. Bearing in mind this is a cross-border presentation, I'm interested in, whether this is necessarily true or not.
The one thing that so when the bonding literature talks about how willing a firm is to bond, or what are the costs, or how willing they are to expropriate, one of the things that it's often tied to is inside ownership. Right? So the more inside ownership that managers have, or the controlling shareholders, the less incentive they have to bond because they're giving up more in that case. Now, I only have limited data on inside ownership, but I have looked at whether the actual ownership level at the firm level. So to the extent that inside ownership captures this notion of willingness to expropriate, I've tried to control for that, to include this ownership data. It's just not there for a lot of my firms. It's very limited. But the results do go through when I try to control with the data that I have.
I mean, I suppose what's in the back of my mind here is a more general point, which is that a lot of this legal institutional research seems to have behind it an assumption that the common law, high litigation environments are kind of better, good, and that the weaker code law environments are worse. But then there's a gap in the literature. I'm aware of no research which shows, for example, that the incidence of expropriation, the incidence of big accounting frauds or other corporate frauds is higher in the weaker environments. In fact, probably the anecdotal evidence will point to exactly the opposite result.
Yeah, and I think, so maybe I understand your question a little bit better. Relative to your first point, the assumption I make when I construct those indicator variables, I mean, is that, right? I'm assuming that a common law legal system is better than a code law. So yeah, that assumption is very clear in the data. But relative to your second point, you're right. I mean, I don't think, I think in general, if you look, I know at least there's the Leutz et al. Study that looks at these legal institutional variables and how earnings management on several dimensions changes. So, and they find that typically earnings management is lower in countries with better institutions.
Oh, hi, Steve. I have another
Yeah.
question. So, what's your take on choosing the change in analyst forecast as the dependent variable to look at? Because if your research question is looking at the market force versus the legal institution, the analyst forecast, I mean, the analyst following will be like strongly driven by the market forces. So I mean, I'm not surprised that, you know, in your results, the market force variables come out stronger. So I'm saying, like, what's your take on giving the research question you're asking? So what's the motivation to choose the analyst coverage as the dependent variable?
Yeah, and this, so some of the caveats I mentioned, definitely not all of them, but there is this issue of, you know, hey, some markets just have more analysts, right? And the fact that it goes up in countries where ownership is diffuse and the equity market's bigger isn't surprising. I do try to control for that. I include a variable that captures the average level of coverage in a given host country to try to get at this issue. But you're right, it doesn't remove all the concerns there are with analyst coverage. As far as your point about the analyst forecast, for instance, just how accurate they are. So I went down this road a little bit, and some preliminary results actually showed that there was no change in coverage, or excuse me, not no change in coverage, but no change in the accuracy. And there could be several reasons for that, and one of those is if the information environment is changing around a cross-listing, it just may be harder for analysts to guess at or try to figure out what the firm's earnings are going to be. So yeah, I did look at coverage. There didn't seem to be any I did look at forecast accuracy, and there didn't seem to be any indication that it was changing one way or the other.
Craig will be our last question, and then we'll go on to Joe.
Okay.
This is sort of a question and maybe a suggestion.
Sure.
Is there any reason why you don't look at outcomes, right? So you're showing us that there's an increase in analyst coverage and in certain countries, and you're using that to distinguish between the role of market forces and legal institutions. Why not look at outcomes, right? You have countries where the host market has legal institutions that come into play and market forces through analysts, and you have countries where the host market has no legal institutions but has analysts playing a role, right? So
yeah.
One way to pick your conclusion apart or provide additional evidence would be to say, okay, let's look at some kind of outcome variable that has relevance for additional monitoring.
So and then relating that to the change in coverage.
Right, and distinguishing between countries where market forces and legal institutions matter versus countries where just market forces matter.
Come into play. And that's a good suggestion. And we can, yeah, I'd like to get your insight on maybe some suggested variables on that.